All right, it's your chairman today. Today's video is actually called Investing Blind for the obvious reason that um, I had a virus affect my eyes, and so I was advised by my doctor to stay away from the light. I think this is since Wednesday. I've basically been indoors in my room with my eyes closed, medication inside from Wednesday. It's basically Saturday sundown at the moment. And so essentially, yeah, I've been locked up right up until today. And I thought, you know what, let me just get some sunlight. Surely I can't die with all this knowledge. Just joking. I just thought to myself, look, let me get some sunlight. Let me be in a space where there's some form of life. You know, I'm not a downer. I'm not usually a person who enjoys being down and out, that sort of thing. So I thought, let me wear sunglasses, and that should keep a lot of the sunlight out of my eyes, and that should allow me to do something. And so I started posting WhatsApp statuses, reviewing Google Bard, the response to ChatGPT by Google. And the idea there was, since Google is connected, Bard is connected to the internet, how much more accurate would it be compared to ChatGPT? So I thought, let me give it a shot. The results were okay, to be honest. There were some mistakes, some factual mistakes. For example, they said a company doesn't exist, which I love, on the JSE. And then I was like, no, but this company does exist and it meets the criteria that I want. And Google swiftly apologized and said, you are correct, this company does exist and it meets your criteria. And then the numbers were still incorrect, so I had to correct it even further and be like, hey, yo, this company actually has a higher dividend yield than what you've given me. And it again had to apologize and say, look, the dividend yield is much closer to your number. Not even much closer, it's actually this number than what we had published. And again, we're sorry for that. And I think that exchange got people going. Obviously, people were impressed that these AI, these sort of tools can start doing that sort of thing. But I think when they contacted me and they were like, why do you need a financial advisor for this sort of thing? I think it hit me that, again, the reason you probably still would is because of that function, that ability to pick up that, no, but that's not correct. This is the correct number. Obviously, that's going to die out very quickly. These companies are very quick at adapting to these things. Hint, hint, I own shares in them. So for me, no matter how they replace me, I don't mind. I'm still going to get paid. Yeah, the eyes. Actually, I thought I'll show you how bad the eyes are. So just bear with me. Sensitive viewers, please do look away. You know, so essentially they're red, and yeah, they've got some medication in them, that sort of thing. Not a pretty sight. Yeah, that gets that out the way. You'll see me reach to the right here, your left, and the idea there is I've taken notes and I'm working on some of the notes. And I think posting today, as I often do, actually reminded me of some of the things that I abide by when I invest. If you haven't yet, my website is www.financehut.co.za. That's where you can get a lot of how to contact me, how to use the financial services that we offer. We manage portfolios, we do bookkeeping and taxation services, that sort of thing. But if you go into the search function of Finance Hut and you type the words, your mouth is moving, you'll find an interesting article that I wrote in 2019. I think that was about 4 to 5 years after I had been investing on the methodology that I'm investing on currently. And by then, I think I was ready to basically say, guys, if you want to learn how to invest, this is it. This is what I do. There is nothing outside of that. And yeah, I've shared that article probably hundreds and hundreds of times, not hundreds of thousands, but hundreds of times. And every time I get exactly the same response. It's so simple. It explains so well things that we struggled with. And I've always tried then to just keep it that way, because so much of the investing world goes over our heads that we forget to keep it simple. I've seen phenomenal returns in South Africa and the US. I think about early last year. I started seriously investing in the US, invested in Facebook, Google, what was that? T. Rowe Price, which is a brokerage house, Oxy, which is an oil company, Intel, Alibaba, Garmin. So I'm quite invested in the US market, and I use exactly the same methodology. And it's what we call the value investing methodology, as espoused by Benjamin Graham. For those of you that have been in this community for long, you'll know that Benjamin Graham was Warren Buffett's mentor. He was a professor at Cambridge University, or Columbia University, where Buffett did his studies in insurance, and I think he also took some classes in finance from Ben Graham. And of note, some of the things that Ben Graham has been involved in was essentially fathering the CFA Institute, which today is actually one of the hallmarks of being an investor and a portfolio manager. So for me, I derived that methodology from reading his books, his original books, synthesizing them for you guys, and making them in a usable format for DIY investors like myself, like yourself. I'm managing about R1 million in assets under management. And so the idea of this video was just, how do I take a beginner and teach them to investing blind, and blind as well, because I have to limit my screen exposure. So it was a double entendre on Ask Me How on that. Shout out Jay. On that. And the idea still there was to essentially take you from 0 to 100 immediately. I won't go through the nitty-gritties of annual reports. That's what you should use for your information. As said earlier in the channel, ChatGPT, as well as its friend Bard, did let me down. ChatGPT doesn't have the latest information, and Bard needs you to prompt it quite a bit for it to give you the latest information. But let's get right into it. You'll see when you read that article that I essentially look at 4 things when I invest, right? You can maybe say 5, and the 5th one will make sense more at the end. I look at debt. I look at earnings. I look at dividends. And then, only then, do I look at share price. That's the 4th thing that I look at, share price. The 5th thing is essentially all of the above, but I will then say how they work together. Is you're looking for what we call a margin of safety, and I will discuss that margin of safety right at the end, and I'm sure it'll all make sense. So I think without further ado, let's talk about the first thing, debt. Now, what most people don't know, don't understand about company valuations, and why did this company go bankrupt despite the fact that we used to love it, despite the fact that it was popular, despite the fact that people have always been buying the shares. You know, the share price went from 90 Rand to 0, or $10 to $1, that sort of thing. It often has to do with the fact that when the bank looks at the financial statements and looks at what's happening in the market, the first panic that they do would be to say, give us our money back. And if you don't have that cash, then you're basically toast, especially when investors look at that and uncomfortable news comes out. And I think debt, for example, played a major role for me last year when Mark Zuckerberg announced, it was actually 2 years back, but it played the majority of the time last year, when he announced that Facebook was going to be changing its name to Metaverse. and essentially be building out this space world that we don't know about. And shareholders were very scared of that, and they basically plummeted the company's shares. I didn't mind, because when I looked at the financial statements, Meta basically had absolutely little to no debt. I think when you look at the cash flows, they could pay off the entire debt, so long term and short term, within a space of 6 months. I think they were generating $20 billion in free cash flow every year, and they had debt of something like 10 to 15 $1 billion. So I was comfortable that, look, the business of Facebook can pay for the business of the metaverse, let alone the fact that they were investing $10 billion in the metaverse itself, building out that metaverse. So it made it easy from a debt perspective to just see that the market is overreacting. There's no way that Facebook can go bankrupt. And that's because there's no bank that's ever going to be able to come and say, give us our money back today. And even if they were to do so, they would find that Meta is sitting on enough cash to pay them off immediately, or they would buy time for about 6 months and then give them their cash. So from a debt perspective, that's the first thing that I always look for in a company. A company that can afford to pay off its debt immediately or within a year, for me, is a very safe company. Almost nothing can shake that company. And if you don't have that mindset when it comes to debt, then it's going to become very risky or very difficult for you to hold on to shares, because shares are going to go up and down, and that's going to play with your fear, greed, whatever, subconscious or innate feeling, so to speak. The second item that I look at is earnings. And under earnings, what I'm looking for is that the company must be profitable, and ideally it must have been profitable for as long as time. But obviously, because I can't go back 50 years to check if some companies are profitable for that long, or in statistics, we call it the information value of time, or statistical value of time, it doesn't make sense to go back more than 5 to 10 years. So a comfortable middle there is 7 years. For me, if the company has been profitable for the last 7 years, I'm happy to invest in that company. And the reason we look at that as well is because that's what we call the business cycle, meaning that in any 7-year period that you pick, you will find everything that a business can possibly go through. And the next 7 years, you will experience different things, but it will have been approximated in any 7-year period. So that's why I'm comfortable from a statistical perspective to take 7 years. It's a full business cycle, and it represents everything that a company can face. I mean, if you go 7 years back now, the company would have been through COVID. The company would have been through a Trump presidential election. If that means nothing to you at the moment, then you really were switched off. The company would have been through Russia invading Ukraine, and a lot of these events that become distant memories very quickly. If in South Africa, it would have been through the ousting of President Zuma. It would have been through a new president being elected in Cyril Ramaphosa, and people being disappointed in his leadership, that sort of thing. So 7 years is quite a lot for a company to go through. And it's quite representative that if a company can be profitable each year through any of those, through the 7-year period, then it can survive essentially any period coming forward. The other reason why I look for profit, and sometimes you find that people say we're looking for an increasing trend in profits, or a 5% growth in profits from last year. The reason I'm comfortable to just take profits and profitability is because at the beginning of each financial year, so be it the 1st of Jan, the 1st of March, the 1st of July, the 1st of October, whenever the financial year of that company is, that company starts from scratch. Facebook, come end of the year, 1st of March, the first thing that they have to do is convince you to keep your Facebook account. Now, we don't normally experience that because it's a subscription service or it's an ongoing posting service. But take something like Louis, a furniture store. On the first of the financial year, which for Louis is the 1st of April, they close the books, and that new sale that happens in that new month and new day is its first sale for the next financial year. And if they work hard and only get halfway of where they got to last year and still be able to pay off salaries, pay suppliers, pay employees, bonuses, that sort of thing, and still declare profit, then for me, that's a company that has done phenomenally well. You can never just keep on growing. There are some years that are going to be slower than others, and I'm comfortable with that. So for me to have a consistent profit history, that is more than enough for me. I'm not looking for somebody to shoot the lights out every single year, because that starts to incentivize fraud on the financial statements. And if you're an investor, the last thing that you want is fraud, and I'll speak to that afterwards. The next thing I look for is dividends. Remember, you sitting at home, you're not a big shot white guy with a blazer and tuxedo and law firms and can institute lawsuits whenever you want. So any returns that the company makes essentially mean nothing if those returns are not being paid to you in the form of dividends. You hoping that the share price is going to go from 0 to 1 million is a long shot. You're much better off putting your money in the company and then sitting and taking dividends every year. I promise you, if you take a 10% dividend every year, at the end of 5 years, you will have doubled your money, both in capital growth and in dividends. And I can tell you now, there are very few investments that you can invest in. You go to the bank, you go wherever, where they will give you a doubling of your money every 5 years. And if you find it, come and give it to me. People will say, but what about if I start my own business? You know the statistics for starting your own business. 99% of businesses barely survive the first 5 years. Of the remaining 1%, 99% of those barely survive the second 5 years. And then of those that survive, about 80% don't survive to become something huge. So you're essentially looking at 0.000213% of companies that get to shoot the lights out. I mean, you can even think of it yourself. If I say name 10 successful entrepreneurs in your country, you can barely get to 10 without pausing and thinking. That's how difficult it is to generate a good return in your country by building your own company. Very rewarding because it actually boosts GDP, but I'm not an economist, and somebody else probably has a video on that. I'm here to talk about investing, and a 10% return in shares in any given year, let alone in a row, is a phenomenal return, let alone if it is cash. And that is why I love dividends, the fact that it is cash. The fourth criterion is the most difficult one, and I'm not even gonna try explain it on this video because it actually requires a calculation. But in essence, what you do is the same way you would walk into a shop and say, listen, how much is this jersey worth? And then they say to you 300 rand. And then you look at the sticker and it's going for 500 rand. You don't buy it, right? Or if you know anything about the quality of garments, diaparo tsa ko kae kae, clothes from this and that shop tear easily or whatnot, you wouldn't pay above a certain amount of money for a particular garment. It's exactly the same with shares. Given that a company has got the following earnings, pays the following dividends, and has got no debt, how much am I willing to pay for it? And one of the measures that we use is what we call a price earnings ratio, a PE ratio, which is essentially price divided by earnings. Why that is important is because it tells you how cheap or expensive the dividends of that company is compared to the price that that company is selling for. And for that, I look for a price earnings ratio of 11 to get my interest, and anything lower than that, I am interested in it. All that a lower PE ratio means is that for the same amount of earnings, I have to pay a much lower price. And that is why I'm surprised in the stock market. when people start panicking, when the price of their company drops. When the price of Meta dropped last year to $80 at some point, I wanted cash wherever I could find it so that I can buy shares in that company. And the reason was, you still have a company with good debt economics, you still have a company with good earnings, and you still have a company that, in Meta's case, they don't pay dividends, but that's for some other video that I will make. But for all intents and purposes, you still have a company that pays dividends, now available at half the price. And when you look at why people were panicking, they were panicking because Zuckerberg decided to grow the company into the metaverse. How stupid. That's exactly what you want your CEO to do, to grow the company. So I decided that, look, at $80 a share, for the same metrics that I last year would have had to pay $300, this is a steal, this is a sale. This is like Gucci and Louis Vuitton saying that we're clearing all of our stock from last year and we're selling everything at cost price. Why would you run away? I would run into the shop and buy all those items. Today, Meta has more than doubled in price, and people think that you're a smart investor for having done that sort of thing. Which brings me to my next point, and the final point in terms of what we had discussed, margin of safety. I can tell you now, you don't need to understand margin of safety to invest. Everything that I've said in the last 12 minutes, it's become 20 because I started with a long introduction, but everything I've said in the last 12 minutes is more than enough for you to go and be able to invest on the stock market and make yourself decent returns. I'll talk to margin of safety. Margin of safety just says, how big is the error rate? Or put another way, you know when you pour sugar and somebody asks you, how many spoons of sugar would you like? Truth be told, between 2 and 4, it's still a drinkable cup. So I can tell you the margin of error for sugar is roughly 50%, meaning that if you pour 4 spoons of sugar, and if you pour 2 spoons of sugar, it's still a drinkable cup of sugar. The quality of taste of a cup of tea or cup of coffee is within that range. If you pour 6, it becomes undrinkable, except to a few people that really, really love sugar. And if you pour none, it becomes undrinkable, again, except to a few very niche group of people that are tea or coffee connoisseurs. For the rest of us, 2 to 4 is roughly the level or the amount of sugar that we would drink in a cup of tea. So it is the same with shares. If a share price, if I calculate that the PE ratio of this company says that I must buy this share at $100, and the share today is trading at $80, that gives a $20 margin of safety. Now, depending on your risk appetite, depending on how good you are at maths or at accounting, you ask yourself, what is the likelihood that I am 20% wrong? And for the vast majority of us, it is very likely that we're 20% wrong when it comes to calculating the value of a share. So the margin of safety that you've got is only $20. The expectation that you're still going to make money, even when you're wrong in your calculations, is only $20 wide. But what happens if it happens like it happened last year, where Facebook or Meta went from a share price of $300 to a share price of $80? There is no way in hell that as an accountant, my mathematics is so bad that I would be wrong to the value of $220. That is a huge margin of safety or margin of error. If I am that wrong, then I need to put away my calculator and stop buying this share thing. So essentially, with a $220 margin of safety, I can then say at $80, Facebook or Meta is definitely undervalued. And if I am wrong, there is still $220 between today's price and what I calculate the price or the value of Meta to be at. And anywhere in between is my money. If literally Meta is valued at $120, I am still $280 wrong or $180 wrong, but I've already made 50% of my money back from $80 to $120. And that's the concept of margin of safety. I hope you guys enjoyed today's video. I hope you learned a lot. I'm Chairman Mo. Today this video was about investing blind, and it was basically just about talking you through my calculations that I would do from start to finish when it comes to valuing a company. In future episodes, I will speak to people that do other things. I will speak to people about investing psychology, philosophy, because outside of this, the only reason why your portfolio looks the way it does and why my portfolio would look the way it does when we are applying the same philosophy would have to be what happens when the market goes up or down. Do you panic or do I not panic? That sort of thing. But when it comes to numbers, today's episode was it. Thanks. See you later.